There are many different ways in which the government taxes your income. Income taxes are the most common way. These are taxes on the income earned by an individual or corporation, generally levied as an increasing percentage of the income earned as income rises. That is to say, these taxes are usually progressive, meaning that when your income rises, you pay a larger percentage of your income in taxes. Payroll taxes are a tax on income which is paid by both employers and employees, generally levied as a constant percentage up to a certain level of income. In the United States, payroll taxes are used to finance programs like Social Security and Medicare. As of this recording, you and your employer each pay 7.65% of your income, for a total of 15.3%. While the law requires that this tax be split between you and your employer, we know from the previous video that this legal incidence does not determine the true distribution, since the wage you are paid will adjust based on whether supply or demand for labor is more elastic. There are also taxes on other sources of income, such as the capital gains tax, which is a tax on the profit earned from the sale or transfer of any capital assets, generally levied at different rates depending on how long the person owned the asset. Famously, Steve Jobs had a salary of $1 per year when he was the CEO of Apple. His primary compensation was being paid in shares of Apple stock. While this avoided income taxes, which would have been higher, Jobs still had to pay this capital gains tax when he sold those shares for cash. The effect of taxes on income and labor markets is the same as the effect of taxes on goods and services. When we look at supply and demand, here the supply of labor and the demand for labor, you can think of a tax like a wedge that we have to squeeze between them. The height of the wedge is determined by the size of the tax. The bigger the tax, the bigger the wedge. But this wedge sets the price paid by consumers and the price earned by producers. For labor markets, that is the wage paid by firms and the wage earned by workers. A tax on income is split between employers and employees, just as it is for goods and services. Who pays the larger share depends on the elasticity of supply and demand. The less elastic one pays more. If the supply of labor is less elastic than demand, then a tax on income will mean employers increase wages a little, but workers will see their paychecks shrink a lot after the taxes come out. Important also is the excess burden of taxation, which we see with the deadweight loss. Taxes on income will discourage people from working more. Think about a doctor who's earning a good income and is considering taking on another patient. They might do it if they could keep all of the money that patient will pay, but since some of it will be lost to taxes, the doctor might decide they would rather have more leisure time and start declining new patients. There are lots of ways in which people will reduce their labor supply due to income taxes, and that is represented by this deadweight loss. So, how do income taxes in the US actually work? You start with the standard deduction, which is a dollar amount non-itemizers may subtract from their income before income tax is applied. Some people qualify for all sorts of tax deductions, and if those deductions total more than the standard deduction, they will itemize them and end up reducing their tax burden. But most people don't have enough deductions to make it worth it, because the standard deduction is bigger. In 2023, the standard deduction was $13,850 per individual income earner. What this means is that you pay no taxes on at least $13,850 of your income. Then you pay according to the tax brackets. These are the 2023 federal income tax brackets. You pay 10% on income over $0, And again, this is after you've subtracted the standard deduction from your income. But on all income you earn over $11,000, the tax rate goes up to 12%. One common misconception is that if your income fell into this 12% bracket, you would pay 12% on all of your income. Actually, you pay 10% on the first $11,000 you earn, and you only pay 12% on the money you earn above and beyond that $11,000. And the brackets continue from there. 22% on income over $44,725, 24% on income over $95,375, and so on. These seem like pretty random amounts, and that's because they're adjusted for inflation each year. So if you're in a future year from me, these tax brackets will be set at different amounts. Let's look at an example where someone earns an income of $100,000. The first thing we have to do is subtract the standard deduction. 100,000 minus 13,850 is $86,150. That is this person's taxable income. They will only pay taxes on that amount. Someone with $86,150 in taxable income will pay taxes in the first three brackets. They won't break into that fourth bracket because their taxable income is lower than $95,375. So, how much will they pay? They pay 10% on the first $11,000 of their taxable income. Then they pay 12% on the income which falls into the second bracket. That is only $33,725 because they only pay it on income above $11,000 up to $44,725. Above that amount, they will pay a different rate. So you take the difference between $44,725 and $11,000 to get the portion of taxable income that falls into this bracket. Lastly, they'll pay 22% on the $41,425 they earn above the $44,725. We find that by taking their taxable income and subtracting the threshold for this bracket. $86,150 minus $44,725 is $41,425. Let's take stock of this. We found this person's taxable income by subtracting the standard deduction from their income. Then we identified which brackets their income is greater than. Since they fall into the third bracket, we know they will pay the full amount in the first two brackets, and then they pay up to their taxable income in the third. All we need to do now is calculate these amounts and add them together. They pay $1,100 in taxes in the first bracket, $4,047 in taxes in the second, and $9,113.50 in the third. That totals to $14,260.50. That is what this person will pay in income taxes to the federal government. That amounts to 14.26% of their total income of $100,000. So notice, even though they fell into the 22% tax bracket, they paid significantly less than 22% of their income in taxes. That said, it is important to acknowledge that the marginal rate they pay on additional dollars earned is 22%, and that could factor into their decisions about whether to work more or not, since they would only get 78% of the additional money they earn. Let's go ahead and give them a raise and see what that does to their tax burden. If they make $120,000 now, then after taking out the standard deduction, they have $106,150 in taxable income. That means they will pay taxes in 4 brackets now, since this amount is above the threshold for the 4th bracket. They still pay 10% on the first $11,000 they earn, 12% on the income which falls into the 2nd bracket, but now they pay 22% on all the income between $44,725 and $95,375, which is $50,650 of their income. Once we get to the highest bracket they fall into, we take the difference between their taxable income and the threshold for the bracket. $106,150 minus $95,375 leaves $10,775 to be taxed at the 24% rate. When we add those amounts together, we get a total tax burden of $18,876. That is an effective rate of 15.73% of their total income. So we can see that when their income went up, so did the percentage they were paying in income taxes. We call this a progressive tax structure. It's important to realize that the tax rates in this table are the marginal tax rates. This confuses a lot of people. Someone might be earning $95,000 in taxable income and think it's smart to refuse a $500 raise because such a raise puts them in the 32% bracket instead of the 24% bracket, and they would end up losing money. But thankfully, that's just not how these brackets work. You only pay that rate on the income you earn above that threshold, which means that no matter what, a raise at work will always increase your take-home pay.